Welcome everyone to today's webinar, Prevedere's 2020 Quarterly U.S. Economic Outlook, with a special report focusing on the coronavirus. Many of you know that we usually present a quarter economic report. This particular presentation today will look a little different. Given our role as a predictive analytics solution that examines global external factors to measure potential impact on future business performance, our team has been fielding quite a few questions about the impact of the coronavirus and what will happen with our financial markets. So this presentation will examine that impact of the epidemic, across different market segments and industries. Hello, I am Nicole Flynn. I work at Prevedere in corporate and partner marketing, and have been doing so for several years now. In my role, I have had the distinct opportunity to work with our talented team of economists to aid customers and the market in general. I am pleased to be here today working with our economist team to present our findings to all of you. And we have a packed house today that says a lot about this topic and that's at the forefront of everyone's minds. So joining us today are two outstanding speakers to cover this topic, both highly regarded in the field. Please extend a warm welcome to Andrew Duguay. Andrew serves as the Chief Economist at Prevedere, and he is joined by Michelle Green. Michelle works as a Senior Economist at Prevedere. Let's take a look at today's agenda. We'll be focusing on three main areas for this presentation. To begin, we're going to focus on the 2020 U.S. economic outlook as a whole. Following that, we're going to get into the coronavirus special report that we're putting together, bearing in mind that information is coming in and this is a pretty fluid situation. And then finally, we're going to focus on U.S. sectors that we are currently tracking. Andrew, do you want to get us started?
Thank you, Nicole. I think we all understand the timeliness of this quarter's U.S. economic update, as we're facing many new and escalating challenges on the global front, particularly from the COVID-19 coronavirus and the impact that this health crisis is having on lives in China and around the world. So first and foremost, I'd like to say, this is a health crisis, and we acknowledge that non-monetary impacts that this has on human beings, as well as the immense complexity in combating and stabilizing the spread of the virus. This does leave us with a greater amount of risk and uncertainty than in previous estimations of future economic performance. And so while we talk about our forecasts and projections, nobody can truly predict where this virus, this externality is actually headed. We want to do our best to present our audience today with some real economic context. So we will be discussing the virus. We'll be talking about impact scenarios, what indicators we're watching, and importantly, what indicators you should continue to monitor, both for potential impacts related to the virus, as well as leading indicators for recovery events should this subside sooner or later. So let's talk about the different current state of the US economy. So last quarter, you heard from our economist, Thomas Kilbane, giving an outlook of the 2020 economy. And in that outlook, we talked about some vulnerabilities that the US economy faces. Now, the US economy is growing and has continued to really grow since 2010, 2011. So this has been a very long economic recovery. However, the theme in most of the indicators that we presented in that last presentation suggested that slower growth was around the corner for many sectors in the US economy, with pockets of weakness, particularly in manufacturing and trade. Now, it is important as we think about the virus and its supply chain disruptions that we consider that already there's vulnerable and weak market sectors that are likely to get tipped rather easily into contraction if these new virus-related disruptions continue for a period of time. So all the while, we will be looking to some of the stronger areas of the market for signals that we can keep the US economy afloat. So far, the most positive factors that are coming out of the US economy are really from domestic consumption. And that's really surrounded itself by US consumer spending, which has lately been buoyed by lower interest rates, as well as favorable weather conditions through the winter season that tends to help shopping as well as new home construction. So let's talk about GDP. One of the key indicators of gross domestic product, or GDP, that we like to follow at Prevedere is our very own Prevedere GDP leading indicator. The blue line on this chart is our custom designed composite that is designed to signal changes ahead in GDP from anywhere from 2 to 3 quarters out into the future. This was actually sending off a lot of alarm signals last year when we were monitoring this indicator because it was consistently falling. And this was despite current activity of extremely low unemployment rates and strong GDP growth. The GDP leading indicator was suggesting that that growth would turn and slow as we headed into 2020. Now, as we look at the latest data points, we need to keep in mind that this does not primarily include the impact of coronavirus, but rather looks at some key longer-term leading indicators that we can look at over the past 10, 20, even last 50 years for signals of key business turning points. Now, anomalies and externalities can certainly impact this, and I would include the coronavirus in some of those impacts. And that's why we're really looking forward to adding to this webinar today with our economist, Michelle Green's analysis on potential coronavirus impact. But setting that aside, looking at some economic context, there was already a bit of signals here that the US economy was going to experience some slowdown. Now, as we look at that turning point in the indicator, what we see is that actually all else equal before this coronavirus event happened, there was actually some positive leading signals that were suggesting that, hey, maybe we're not headed for recession this cycle, but we could be on the brink of a new recovery cycle and see recovery much like we saw in 2016 or even in 2012, where the economy experienced some vulnerability, some slower growth, and even some industries that went into contraction, but the US economy as a whole and consumer spending did not contract. Those are the sort of headwinds and tailwinds that we're looking at and considering right now as we head into 2020, is that coronavirus aside, we're basically at a vulnerable spot in the US economy, but we're not seeing signals of an outright recession. Now, different scenarios for coronavirus could obviously introduce greater risk of recession, and we will be talking about that. But let's keep in mind the broader context is that we do see some positive signals coming out of our GDP leading indicator. So where are we seeing weakness? Where should we be concerned? So one of the indicators that has really been sending off a lot of red flag signals has been this ISM Purchasing Managers Index for manufacturing. This blue line, as you see, it ebbs and flows. When it gets below 50, that technically means contraction in the manufacturing sector. Now, we know manufacturing has been taking hits from the left and the right throughout the past 12 to 24 months based on different challenges from a changing trade impacts impacting the supply chain, as well as fluctuating commodity prices and slower growth in Europe and Asia impacting demand for exports. So when we look at the environment for manufacturing, any sort of impact from coronavirus might accelerate an already weakening trend. I think it would be interesting to see that as we see this blue line going down, right, as we're looking at data from 2019, that all of this happened before we started seeing this externality from coronavirus. So what we're really into a context that, hey, we might have a recovery in place with the latest manufacturing PMI rising a little bit. However, it's still around 50. It's not signaling strong growth or decline at this point. And it's going to be very interesting to watch this indicator going forward. Particularly interesting because some of the latest data out of China, there's equivalent indicators that look similar to this, other purchasing managers indices, and Michelle will show us later that the China equivalent of this data set shows very, very negative signals. So what this means for the US economy is that while China, and when we look particularly at the data in China, it's very negative right now. For the US, it's more of a temporary supply chain disruption. When we look at the US equivalent of this data set, what we see is that there are not really any red flags yet in US manufacturing related to coronavirus. However, what we're seeing is that the symptoms more of a temporary supply chain disruption. So when we look at measures like supplier delivery times, we're seeing those elevate quite rapidly due to supply chain disruptions coming out of China, with manufacturing at about 50% capacity or less for many goods and products that get sent overseas to the US. However, the demand is still there in the US, and so we are seeing inventories get depleted and increase in supplier delivery times. But all signals would point to the fact that if those supply side issues from China recover, then the US manufacturing system would continue unabated, essentially, just viewing this as a temporary supply side disruption. I think where this would start to show a lot of more negativity is if demand side started to weaken, and then we saw a combination of lack of supply and lack of demand could really send these signals a lot lower. But we're not seeing those signals yet. But as coronavirus continues to show impacts, we might expect that these kind of indicators might show up in a month or two, might be very telling about the negative impacts to manufacturing. And when we think about the broader context of business investment, it's something we've been actually watching for the past few quarters. What we're looking at here on this chart is business investment growth by quarter. And what you'll see is that for the past 3 quarters in 2019, we already seen year-over-year decline in fixed business investment. Now, this is interesting because this is a trend that has really not been seen recent precedent in this economic recovery cycle. Businesses are being more conservative. They're investing less in equipment or buildings, intellectual property on a year-over-year basis. So these are some early signs that this economic cycle already might be on the more mature phase, as businesses tend to shift to a more conservative position after long periods of economic growth. What this could mean for US economy is that businesses could be starting to question as they move into 2020 and also see the downside implications of this virus, that they could continue to pull back on business investment, and that could even start to impact the consumer sector through things like reduced overtime or reduced job openings and job hiring. So we really have to be careful when we're looking at the entire business context, because yes, unemployment is down right now, and yes, the consumer is in a pretty good position from wages and job opportunities, but that relies on businesses continue to invest in the long-term prospects of the US economy. And right now we're seeing some contraction in business investment, and given all the uncertainty that has now crept up on us in 2020, that's a trend that could likely continue going forward. So that's something we're continuing to keep an eye on. But let's focus to some of the bright spots. And one of those is the power of the US consumer. So yes, there's a lot of uncertainty right now. What we're going to be watching for is, does that uncertainty actually translate into changing consumer habits? And so some of the hard data that we watch are very common sense indicators, such as wages and inflation. If wages are growing above inflation, then we know consumers have increased spending power, and that has really been a huge driver of economic growth over the past 5 years, the fact that wages have continued to outpace inflation at a steady rate. As we look at this chart, there's 3 lines here. 2 are wages. The solid 2 lines are wages based on hourly wage growth and weekly wage growth. And then that dashed line is inflation. And one of the interesting trends, of course, over the past 5 years has been that inflation has been very subdued. This organically creates spending power in the consumer as consumers have more money to spend on an inflation-adjusted basis. Now, we're seeing a couple trends develop here in 2019 that are really carrying forward into 2020. One is that weekly and hourly wage growth continues to outpace inflation, which is a good thing. But the second thing that I want to call out here is that there's this gap now between hourly and weekly wages that started to develop, and weekly wages actually creeping up quite close to inflation again. That gap actually represents that reduced hours per week that are being worked. And so this is where we start to look for periphery economic signals here. If we look at overtime hours, right? Maybe overtime hours are starting to get reduced. Unemployment stays the same. For salary workers, their wages stay the same, but for those who have fluctuating wages, the signals here are that they're starting to work less hours, and there's a little bit more slack in the labor market than there was maybe 6 or 12 months ago. And as that gap starts to widen, we're kind of monitoring to see, is there any sort of weakness that's developing in the wages trend? So right now, this is more flashing maybe an early warning signal, but isn't anywhere near the territory that we would suggest of contraction. That's very important because of all the headwinds that the US economy is facing. Now, we've gone through cycles like this before. I would say particularly if I think back to the last economic cycle in 2016, we saw a lot of manufacturing weakness, and we even saw commodities go through a contraction, but the US consumer kept the US economy afloat. We did not see recession. We just barely saw a slower growth for a couple quarters and then a rebound. So here are the broader indicators that we're watching to signal what is 2020 going to actually look like. Again, with the big asterisk of the impact of coronavirus, which Michelle is going to dive into. So when we look across the board, we're seeing a mix of green and cautionary signals. So when we talk about these signals, we throw up different colors. Really think about this as, hey, green is a positive leading indicator calling for maybe even faster accelerating growth into the future, whereas some of these yellow and the darker the yellow and the orange, it really means the more cautionary we are really signaling anywhere from slower growth to actual contraction. You'll notice that purchasing managers index, which has been floating below that 50 line and signaling weakness, is one of the more negative sectors and has been for quite a while. But for other sectors, it's really a mixed bag, right? We are seeing some deceleration in automotive, but if we really look at retail sales per person on inflation-adjusted basis, or even consumer sentiment, interestingly enough, at or near record highs, most measures of consumer sentiment up until the past couple of weeks, as consumers were largely positive. It's really going to be interesting to see if a virus scare starts to change consumer attitudes, but it is important to keep in mind that up until this point, consumers have been extremely happy by historic standards, and that's usually good for ongoing shopping, particularly when unemployment rates are so low and wages are outpacing inflation. So there's some strong fundamentals here that really have to deteriorate before the US economy as a whole moves into contraction. And I think that context is very important as we look at 2020. Perhaps some of the vulnerabilities that show up in the economy can be combated by the strong consumer. So when we talk about indicators, we're really talking about, can we see the foremost leading signals out into the economy? And so this is, we have to put on a little time dimension into our thinking here, is when we're talking about things like the inversion of a yield curve or the fact that volatility is increasing in the stock market, some of these can be anywhere from 2, 3, 4 quarter out leading indicators. So if the yield curve inverse is this month, that could be actually a signal for late 2020 of contraction. And so when we're looking at some business B2B and some financial indicators that were giving off some really negative signals last year, a lot of those are still suggesting a weakness in the latter half of 2020. And so we have to really watch out for those. It's really more of those near-term signals that, hey, the consumer's still healthy, they're still spending, they still have income. Those are more of the short-term leading indicators. So it's really going to be important to watch how the consumer is doing to see if they can really counterbalance some of these negative signals that we were seeing on business investment and from the financial market. And then, of course, naturally from the last few weeks where we've seen the stock market really take into account a lot of this uncertainty and make some corrective actions. So as we look at our 2020 outlook, we're still looking at a slower growth scenario in the US, but there's a lot of scenarios to play out with this new coronavirus that we do need to talk about in more detail to give more context to that forecast. So with that, I'm going to turn it over to my colleague, economist Michelle Green, who has been doing some analysis on the virus. Michelle?
Thanks so much, Andrew. Why don't we go ahead and start by looking at the number of confirmed cases that are spreading across the globe. This is a view as of March 3rd, 2020. And what we see here is that this, and what we know from reading the headlines, is this is really a rapidly evolving situation. We don't yet know the full impact, economic impact, but we do have some clues from previous economic impacts that can help guide our analysis as we move forward. And so to determine that economic impact of COVID-19 specifically, we're going to look back at some of the previous effects of prior disease outbreaks on economic outcomes. And we're also going to discuss some key characteristics of COVID-19 that make it unique in terms of comparison. We're also going to dive into the depth of increased economic risks around the globe, as well as in the US, as Andrew was talking about, where the impacts based on our analysis are not really expected to be equal across all nations or regions. For example, countries and regions which were already experiencing significant headwinds for 2020 are expected to see economic conditions deteriorate faster than others. So for countries like Japan, Italy, Germany, possibly even Australia, those are all at greater risk than the US in terms of impact of coronavirus. And finally, we're going to evaluate the specific risks to the United States economy that Andrew sort of highlighted already for us. And we'll look at some additional key indicators to watch throughout this rapidly changing epidemic. Okay, to begin our analysis, let's take a look at retail sales in China, where the outbreak began. If we compare previous disease outbreaks to what we're seeing now with COVID-19, we can see that in previous outbreaks, the impact on retail sales in China was minimal. The most comparable to our expectations would probably be the SARS epidemic in 2003. But if you look at some of the other more recent epidemics, there really was virtually no impact on overall retail sales in China. What I do think is particularly interesting here is that you can see with some of the newer data available that consumer sentiment, particularly around things like electronics, did soften in previous disease outbreaks, but that softening in consumer sentiment didn't really translate into overall declines in retail sales. In terms of the coronavirus, we think it's probably going to be a mix of the two, right? So considering that China in particular has been impacted by severe quarantine and production delays, we do think there will be at least some impact on retail sales, most comparable to the SARS epidemic, but just like in 2003, we're expecting that swift rebound in retail sales activity as soon as consumers are able to get out again and factories are able to start producing again. Similarly, as we look at industrial production and manufacturing in China, across previous disease outbreaks, SARS seems to be the most comparable to what we're anticipating with COVID-19. But we can see that there again, in previous disease outbreaks, the impact on industrial production in China has been minimal. The timing of this particular outbreak may prove to be different this time around, because not only has production been halted for a couple of weeks due to the virus itself, it was also already in a seasonal slowdown due to the Lunar New Year. So that could exacerbate some of that slowdown that we're expecting in this first quarter. But most economists agree that the rebound, at least in China, will likely be swift and sort of following that 2003 pattern that we saw during the SARS epidemic. As we look at annual GDP growth, we see here that the previous disease outbreaks have had virtually no impact either on Chinese GDP growth or on global growth. And the one outlier that we saw was in 2009 when the H1N1 epidemic was beginning to spread about the same time as the Great Recession hit. But again, most economists agree that in the current outbreak, we're likely going to see a larger impact on global growth than in the past. And one of the reasons for that is that China's GDP makes up a much larger portion of global GDP today than it has during any of the previous epidemics. So, it's not surprising that this has led to considerable panic in the financial markets and a great deal of speculation over what the long-term economic effects of this virus will be. That's reflected here also by the OECD projections for 2020, which were revised early this week. Based on the current outbreak, the OECD has revised global 2020 GDP growth projections by 0.5 percentage point. So we're now looking at 2.4% in 2020. And they've revised downward the Chinese GDP growth by 1.2 percentage points. So we're now looking at 4.9% GDP growth for China. But similar to previous outbreaks, what I think is particularly interesting is that in their revisions, they're still projecting strong growth in 2020, suggesting that, the overall economic impacts of coronavirus are expected to be short term, assuming that the spread of the virus can be contained in a relatively short period of time. But as I mentioned previously, there's a good reason to believe that the current outbreak is unique in a lot of ways. And as infections spread globally, we start to get a glimpse of the severity and magnitude of the current economic impact. That in turn is leading the probability of a V-shaped recovery to decline. As we see here, the manufacturing and non-manufacturing activity in China, which is sort of the counterpart to what Andrew was showing in the US, were recorded at their worst levels in history in February, lower even than during the Great Recession. So the severity of this slowdown is likely to have far-reaching implications in terms of the geographic scope as supply chain disruptions expand and inventories across the globe dry up. Financial market activity is another important factor to watch. Though market reaction was slow in the beginning of the outbreak to react, in the last couple of weeks we've seen huge swings in financial markets as investors seek information on the rates of global infections, as well as information on how central bankers and policymakers are going to react. So what we see here is the CBOE volatility index, which is one of the most closely watched measures of expected volatility in financial markets. And our most recent information is showing significant spikes in February and March, almost rising to the level of where they were in 2009, though they have been moderating a little bit toward the end of this week as central bankers and policymakers start to make their policies known. For example, markets are reacting quickly and heavily to some of the announcements coming out from central bankers across the world. We saw the Federal Reserve cut interest rates by 0.5 point on Tuesday in an effort to calm markets and contain economic fallout from the virus. And these are some of the things that we'll be looking for moving forward, though it's unclear how markets will react in the long term. So what we're looking at is really 3 scenarios based on how long it takes for this global spread of the virus to peak. So if the virus peaks before the end of March, as some are suggesting, the expected impact is likely to be localized and isolated to economies that have been most at risk to global headwinds already. So places like South Korea, Italy, Japan, who either have highly connected supply chains or were already facing significant economic headwinds going into 2020, they might see a more severe economic impact in Q1, maybe Q2 of 2020, but the rest of the world is likely to see that sort of V-shaped recovery in Q2, and that would include China. The US, because of some of the more optimistic signals that compared to other places in the world, likely will have a minimal impact if the global spread of the disease is contained before the end of March. If it takes until the end of April, the economic disruptions are likely to continue toward the end of Q2 and spread to more countries within multiple geographic regions. So you might see economic distress spread from Italy and Germany into the European Union and maybe even more broadly into Northern Europe. You might see impacts of Japan, declining activity in Japan and South Korea spread to wider areas in Southeast Asia. But in the US, we still think that there's enough positive signals or enough strength in consumer markets that even if the disease were not contained until the end of April, the risk to the US economy would likely be minor to moderate at best, with a relatively swift recovery as soon as those production lines and supply chains were reopened and started that rebound. If, in our worst case scenario, the peak of new infections doesn't occur until the end of May or possibly even later into the summer, there's a much higher risk of a global recession at that point, as those negative economic impacts reach all major economies and recovery periods drag into the second or third quarter of 2020. In that case, there's a much higher elevated risk to the United States outlook, as inventories are not likely to be able to keep up with consumer demand, as American consumers start to become more fearful about going to brick and mortar shops and risking infection themselves, and consumer spending likely to see an impact there. But that's, it could go either way. So we still have quite a few indicators to monitor, because we don't yet have enough information to determine when the disease outbreak is going to hit its peak. And that's really a medical question, not so much an economic question. But nonetheless, there are some key indicators, in addition to the ones that Andrew mentioned, that we're going to be monitoring just in order to get a clearer picture of how long the economic impacts and how far-reaching and how severe those economic impacts might be as we move into the second quarter of 2020. So here they are. Things we're going to be looking for are particular industry vulnerabilities in the U.S. to transportation and tourism, logistics and manufacturing, obviously, business investment, and financial markets. We're still waiting on a lot of data to come out, so some important releases are going to be happening within the next few weeks, but we're looking to see how consumer sentiment changes for the first half of 2020 with regard to entertainment spending, vacation plans, hotel occupancy rates. We're also looking at broader retail sales, which should be coming out mid-month. In terms of supply chains and manufacturing, there's a lot of information that we're kind of waiting on this month, hope that we'll be getting relatively quickly. Trade data in terms of import and export volumes, import and export price indexes will give us a lot of information about what we should expect in terms of the lasting impact of supply chain risks, as well as potential shortages in raw materials and things of that nature. Industrial production will give us an idea of how resilient U.S. manufacturing, the U.S. manufacturing sector is to this sort of slowdown in supply chains and how impacted they are, whether or not they're able to keep production going at a rate high enough to meet consumer demand. And we'll also be monitoring that US PMI data very closely to see if that potential inflection point changes direction. In terms of business investment, there are a lot of things to keep an eye on as well. Some additional indicators that Andrew didn't mention earlier, jobless claims that will be coming out at the end of this week. Job openings, which is a great sign of cooling in the labor market, will be coming out mid-month, and we'll really be keeping an eye on construction spending, particularly non-residential construction spending, to see how coronavirus impacts to the broader economy might start to creep into business investment and consumer health. And then finally, we'll be monitoring the financial data. As most of that data is published daily, we expect to have relatively quick insights available as changes in the financial markets evolve. And with that, I'll turn it back to Andrew.
Thank you, Michelle. So really, in summary, I think the landscape we want to paint for our customers is that we have an expectation of continued slowing growth in the United States. Indicators long before coronavirus became a household word were signaling that the US economy was going to grow in 2020. However, most sectors grow at a slower pace. And so that is still our outlook for the US economy in 2020. But however, there is, of course, elevated downside risk that Michelle covered with a few different scenarios. It's really about leaning on the back of the consumer at this point. Sure, manufacturing has taken hits and will continue to face challenges in the first half of the year, but the consumer has been the real strong point of the US economy, and we will continue to monitor a lot of those consumer-driven indicators to make sure that we are not faced with anything more than supply chain disruption and some temporary first half hits because of the virus with some second half recovery. If the consumer starts to behave a lot differently, then we definitely need to reassess that outlook. And so we'll be continuing to focus on consumer indicators. And then there's other bright spots in the US economy that don't concern global trade, but one of them is construction. I'm sure construction has been helped out by a generally mild winter, but to see new home sales and housing starts both rise above year-ago levels and accelerate forward over the past several months is a positive spot, and they're responding positively to lower interest rates. So that is another sector aside from consumer spending that we're looking at as a positive indicator. And then we're also, again, focusing on financial signals. I think in times of uncertainty like this, the financial markets can throw off a lot of odd signals, right? Because everyone has heightened uncertainty. However, just the real-time aspect of a lot of that data can also be very insightful into what businesses and consumers are going to face down the road. So peeling back those financial signals for good, solid leading indicators is part of what we'll be continue to do for our customers. And then continuing to put that context around the coronavirus to what those increased downside risks are. I think some of the things we learned today are that typical past epidemics have been met with a quick downturn in demand and supply side factors, followed by a recovery that recoups most of that downside impact. However, coronavirus, I think, is quickly shifting from the use cases of the past, like SARS and H1N1, to this kind of new global epidemic that's a lot stronger. And so we are kind of looking at the domino effects that will have, what countries are more at risk. We think that the US is on the safer risk area based off of exposure to supply chains and China versus some other countries that might do a larger portion of their trade with China, or their manufacturing supply chains are much more intertwined. So there's pros and cons to each situation, and I think we're going to continue to monitor that as it goes on. But we need to see the real signals here in the US. And so while we are seeing some very negative numbers coming out of China, in the wake of this, we want to, again, ground our indicators and our forecasts in hard facts. And so we continue to turn to consumer sentiment, consumer markets, domestic production, and business investment to get some real measures of the real impact versus the threat of impact. And that's an important thing to distinguish during these times of uncertainty. But new information is coming out daily, and that's why I think it's very important times like these to lean on economic data and consider the broader context of the global economic business cycle as we go into these very uncertain times surrounding the virus. So that's our outlook in summary, and I'll turn it over to you, Nicole.
Oh, thank you. Thank you both for your presentations today. Really appreciate the retrospective outbreak assessment reminders as well. It puts things into perspective and we can hope for the best. So thank you everyone for joining us today. Should you have any questions for our economists, please feel free to contact me directly and I will forward on your inquiry to the right person. Additionally, we will follow up this presentation with a recording from today and a series of reports just to ensure that you're updated on the latest impacts of the coronavirus and what that may mean for our economy and your industry as the fluid environment shifts. As both Andrew and Michelle mentioned, we're receiving updated information in real time and we'll be communicating as we know more. So stay tuned to our blog and your Prevedere incoming emails for more information. Thank you for joining us today and have a lovely rest of the day or evening where you may be. Thank you.